Okay, thank you. Welcome once more, my friends. I think we can proceed on from where we left yesterday. And before we proceed on, we can have a small recap of how we started, where we started yesterday. Then we can build on it up to today, move on to the practicals that we agreed yesterday we'll be doing. So yesterday, we had a discussion, and the discussion was, us as accountants, there are many times after we have sold, we have recognized our receivables, we reach at a point where we feel that some of the people we have sold to might not be able to pay us. And normally, it's possible that sometimes we can go through the list of the customers and we pick out those that we feel are becoming troublesome, and therefore they will not be able to pay. Or alternatively, we could be running a big company such that even picking up, we cannot exhaust the customers that we feel are not going to honor their obligation. Or even so, we could be aware in the list that we have, the customers that we feel will not be able to pay. But the challenge is, we might have other customers whose circumstances might dictate that they will not be able to pay after we have come up with the list that we feel is of bad debtors. So the question therefore becomes, how then do we come up with the element of provision for bad and doubtful debts? Because us as accountants, it's expected of us that when we are preparing our books of accounts, we should also account for the bad debts, so that the balances of receivables are not materially misstated. They can honestly portray a true and fair view. So the question becomes, how do we make a provision for bad debts? And I remember yesterday saying that initially the provision of bad and doubtful debts was a preserve of the management. It used to be a preserve of the management. So the management would come and say, kindly look at how we have been able to sell. And the management will come up with a policy and say, when we look at our aging analysis, and we have 0 to 30 days, we have 31 to 60 days, we have 61 to 90 days, we have 91 to 180 days, and we have in excess of 81, we also have 181 to 360, and we have excess of 360. Then the management comes up with a policy, and it says, look at the customers that are within this range. Let us make a provision of maybe 0.01. Why? Because they have not stayed with our goods for long. Then for this one, maybe you can provide 0.5. Then for the ones that fall within 61 and 90, you make a provision of 1%. Then for this one, be able to make, for example, 1.5%. Then for 81 to 60, be able to provide, for example, 2%. And then they tell you, for these ones that are in excess of 360, we believe they will not be able to honor. So what do? Just provide 100%. This is a hypothetical example I'm just giving. So every management will have its own opinion and its own rates as far as this is concerned. So in the books of accounts, you as an accountant or a finance manager, you will go ahead and be able to prepare the aging analysis and make a provision for bad debts based on what the management has given you. But this has a challenge. Why? If this company X is in a specific industry, then it means we might also have company Y in a similar industry with different rates. We might have company Z, similar industry with different rates. What is the challenge? It means the provision for bad debts for company X cannot be compared to the provision of bad debts for company Y and cannot be compared to the provision of bad debts for company Z. So the financial statements prepared will violate the concept of comparability because the provisions cannot be compared. So the receivables also cannot be compared. Therefore, it necessitated that we must have a framework that will be able to give a guideline on how the provisions of company X in this industry will make its provision, and it will have a relationship or comparability with the company Y provisions, and they will also have comparability with company Z provisions, as long as these firms are in the same industry. That's why the concept of IFRS 9 came into being. So what happened? Therefore, we have a full-fledged financial statement called IFRS 9, dealing with financial instrument that came into play that now helps us to provide for bad debts. Now, I said yesterday that IFRS 9, when they are giving guidelines on how to prepare provisions for bad debts, it gives two approaches. The standard allows us two approaches. Number one, I talked of the general approach. And number two, I talked of the simplified approach. And in our yesterday discussion, we dwelled so much. In fact, the entire of our discussion was on the simplified approach. It's only that the practical part was not exhausted. And that's why today, I want us to have a look at the simplified approach in details, including example, to put it to an end. But way before we go to the details of the simplified approach and the general approach, I will want to clarify the difference between the two. And in our yesterday discussion, we talked of one statement that separates these two. In that statement, we talked about significant financial component. That is the statement that separated the two. So the issue that we discussed is, what is the significant financing component? What is the significant financing component? And I explained that the significant financing component is the element that makes a receivable to have an interest component and pushing the receivable to be paid in more than one financial year. The classic example that we gave was the loans being provided by banks, microfinance institutions, or even Shylocks, as long as they have interest components payable in more than 12 months, such that for you to get the value of this loan, you must get the present value. Then it becomes a significant financing component. If it is the exception, then it does not have a significant financing component. So if it doesn't have a significant financing component, for example, when we are dealing with our trade receivables payable in 1 year, or we are dealing with our construction contracts payable within 1 year, then all of them, as long as they do not have significant financing component, they must be evaluated based on the simplified approach. If they have a significant financing component, then they must be evaluated using the general approach. Number two, when you are dealing with the general approach, there are 3 steps that you will need to follow. But when you are dealing with the simplified approach, we'll have other steps to follow, but you will assume and take that this provision for bad debts is for a lifetime. It occurs once and it's for a lifetime. So I remember yesterday when we went ahead and discussed about the simplified approach. And that's why now today I'm going to dig deeper. We have a discussion on the simplified approach because majority of us where we are employed with employers that deal in the sales of products, deals in the sales of services. We are not in financial institutions. And even if we are in financial institutions, we are not at a policy level where we normally make decisions on how provisions are done. And I said, it is necessary that us as accountants, we understand this concept of provision for bad debts. Why? Because it is the responsibility of the directors to prepare financial statements. The directors have delegated the responsibility of preparing the books of accounts to you as an accountant or to you as a finance manager. And so it's expected of you through delegation that you will be able to give out your books of accounts for audit purposes, books of accounts that include provisions for bad debts. Let me tell you, friends, it is not the responsibility of the auditor to prepare provisions. The moment the auditor starts preparing provisions for bad debts and he gives you, normally in many circumstances, you will realize that the financial statements will not be able to agree with your accounting system. So it is required. The onus is on you as an accountant or as a finance manager to learn how to prepare provisions for bad debts. Simplified model tells us that you as an accountant, you must be able to understand your accounting system. And the basis of understanding your accounting system so much will take you back to knowing how do we sell and how do we track our customers. That is fundamental. And we discussed about it. Remember, friends, when we were discussing about IFRS 15, we were talking about recognition of revenue from contracts with customers. So during our discussion of this standard, we were asking ourselves, how do we recognize revenue? But what we never addressed at that point is that the revenue we have recognized in the income statement has got a double entry portion in the balance sheet that goes in as a receivable. So that means that as much as we are tackling this standard to deal with revenue, we must also rush to the balance sheet to tackle another element that is there called receivables, but now we are tackling it using IFRS 9. And the reason we are going to tackle it using IFRS 9 is that so that we can be able to make a provision for bad debts. So I want us to agree on something. It means, therefore, if you have a challenge with IFRS 15, it is possible you will also have a challenge with IFRS 9. It is possible that if you have not accounted for your transactions very well in the accounting system, you will not be able to unlock IFRS 9. Why? Because unlocking IFRS 9 as you see it, you must have passed some things. And what are those things? Your transaction must have well been recorded in your accounting system. Remember, if your system cannot be able to give you the aging analysis, then you'll have a challenge with IFRS 9. And where your system cannot be able to give you aging analysis, you will not only have a problem with IFRS 9, but there is also a bigger problem, that there is a governance problem, because for you to have the aging analysis, we must have our credit policy documented somewhere. Friends, remember, I said this during our first training. There is an accountant, it is not just an element of posting transactions. The transactions that we post in our accounting system and that we account for emanates from a source. And one of the sources where they emanate from is from the systems that have been built. It could be accounting system, it could be internal control system. As sales are concerned and as receivables are concerned, we must have a policy within our own company that tells us, look here, when we sell today, assume we are selling 20,000, then this customer J must be able to pay this 20,000 within 30 days, or within 60 days, or within 90 days. This policy must be able to exist. So as an accountant, if you're working in an organization where they sell goods on credit, but you do not know when the customers are supposed to pay for these goods, then you are in trouble. Why? Because in as much as the salespeople are going ahead to sell, you will have a challenge of how to recognize these figures in your accounting system. You will not be able to explain to the management who has defaulted to pay within 30 days, who has defaulted to pay within 60 days. The credit policy is very important. Now, once the credit policy has been defined and has been given to the accountant and the sales has been made, now the accountant has a basis to be able to account for the receivables when they were supposed to make their payments. And then at the end of the day, the accountant can be able to run his aging analysis and present his report as it is. Once he has presented his report, then the accountant moves to the next level, where now he makes a provision for bad debts. So how then should the provision for bad debts be made? According to IFRS 9, listen to me, friends, for you to be able to understand how your customers have behaved this year, you must go back historically, some periods behind. It could be 1 year, it could be 2 years, for you to study how your receivables behaved in those years as a basis of being able to project how those customers behave this year and how those customers will behave next year. In other words, the behavior or the characteristics of the customers this year will be able to give you an insight of knowing how they will behave next year. With the exception of other emerging items. So that means the behavior of customers in 2022, the behavior of customers in 2022 will be able to help us project how the same customers will behave in 2023. And it can also help us to project how the same customers will behave in 2024, apart from some emerging information that might cause the behavior of these customers in 2022 to deviate in 2023 from how they behaved in 2024. So that tells you that as an accountant, when now you are going to when you are going to study the behavior of your customers in the historical period, you must also factor in other emerging factors that might be able to affect these customers in the future. So that means if we need to know how we are going to prepare the rate at which our customers in 2023 have defaulted, then we cannot start with the 2023 default. We now first have to move back to 2022 to compute how they defaulted to pay us, as a basis of saying, if they defaulted last year to pay us with 2%, then it is probable that even in 2023, they will default to pay us at 2%. And it's also probable that in 2024, they will also default to pay us at 2%, unless we have some other factors that may come into play. So it is the responsibility of you as an accountant to ask yourself a question. When I look at my customers the way they are, be it based on the product that I sell, be it based on the regions, do we have some other factors that I think might be able to affect my customers? And let me tell you, the factors that can affect your customers' behavior in 2023 to be different from how they behaved in 2024 always are macroeconomic factors. So that tells you as an accountant, therefore you must be able to understand what are these macroeconomic factors. What are we talking about? We are talking about the simplified approach. What are we saying with the simplified approach? Number one is you are supposed to compute the rate of default in previous periods. That is your objective number one. But before you compute the rate of default in the previous periods, friends, there is a critical thing that you must first do. What is it? You must be able to classify your customers. You must be able to cluster your customers together. If you want to understand the characteristics of your customers, then bring the customers who behave in a similar manner together. What do I mean? Bring customers who have bought the similar products together. Bring customers who come from the same region together. Have a mechanism, you yourself as an accountant, to classify your customers together as number one. Why? If we are having customers that are buying motor vehicles, and we have customers that are buying motorbikes, and we also have customers who are buying bicycles, then one thing that as an accountant you must understand is if you combined the customers that bought motor vehicles with the customers that bought motorbikes and those that bought bicycles together, you will not get the true results because the behaviors of those who bought motor vehicle are different from those that bought motorbikes. What do I mean? The customers that bought motor vehicles have a higher purchasing capacity as compared to those that are buying bicycles. So the rate of default for customers with motor vehicle cannot be compared to the rate of default for the customers that are buying what? Bicycles. So number one, classify your customers together and justify the basis of classifying them together. Let me give you another classification. You can also classify your customers based on the regions. For instance, if right now we are selling our products and we have customers in DRC Congo, then our cluster of customers in DRC Congo, as it stands now, would be different from the customers that we have in Tanzania and those that we have in Uganda. Why? The political instability in DRC will make the customers in DRC be volatile and be susceptible to default as compared to the customers in Tanzania or to the customers in Uganda. Even so, the same customers in DRC in 2022 will have a different behavior as compared to the same customers in 2023 and to the same customers in 2024. So when now you want to compute the rate of default of customers in DRC in 2024, where we are right now, and they had their election last year, then you must factor in the aspect of political transition. That in an event of an election, and the election is not favorable to a certain section of the masses, what are the chances that my customers might not be able to pay? So that tells you, if this election happens every 5 years, then you must be forced to go back -5 to almost 2020 to 2018 and ask yourself, in 2018 when we did our sales, did we have political instability? Yes. If we had political instability, what was the shift in recoverability? So what do I mean? I mean, for you to be able to go back to get the rate of default, it is not just academic and mathematical. You must apply the thought process. So, I want us now to have a look at a practical example. And once we finish the practical example, then I can be able to give a question which all of us can be able to tackle, and we'll have the results as we move on. Now, this is the example that I want us to have a look at. Assume this company is called Champions Limited. The year end is 31st of December, 2023. Just a few days ago. Now, you as an accountant, when you joined this company, one of the things that you wanted to have a look at that will be assets for you was the procedure manual. You looked at their procedure and finance manual, and you went and studied about receivables, and you analyzed the credit policy about receivable, and you realized that the credit policy is 30 days. So every sale that this company, who is your employer called Champions Limited, makes, the customer must pay within 30 days. That is the information that you have. And then you realize that you are having receivables. The moment, first of all, you realize the credit policy is 30 days, what comes into your mind? Whatever comes into your mind is the concept I talked of, significant financing component. How does it come into play? Because my credit policy is 30 days, so I'm expecting my payment within 30 days, and my payment does not have any interest. I'm not expected to receive payment outside 1 year. So it therefore means that when I'm looking at my customers in January have the same value as my customers in February, have the same value as my customers in December. Had it been that I need to get this money within 3 years, then it means my customers in year 1 would have been different from year 2 and would have been different from year 3. So, giving me another aspect where we have a significant financing component, because my receivables in year 2 will be different from my receivables in year 1, and therefore for me to get the total receivables, I will be required to get the present value of my receivables. But because my credit policy gives me 30 days, it is within 1 month, my reporting is within the 12-month period, there is no significant financing component, and therefore it's telling me that when I'm going to make provisions for bad debts, I will use the approach called the simplified approach. Then you realize you come and you run your aging analysis. And when you run your aging analysis, you have your 0 to 30 days. You have 31 to 60 days. You have 61 to 90 days. You have 91 to 180 days. Let's try to make it a bit, we can even 61 to 180 days, then 180 to 360 days, and then in excess of 360 days. And then you realize that you have 800 here, you have 350 here, you have 280 here, you have 170 here, and then here you have 100. You've just gone to Tally, or you have gone to QuickBooks, or you've gone to Sage, or even they are using the subsystem, and when you ran your aging analysis, you realized that you have between 0 and 30 days, 800 customers had not paid. Between 31 and 60 days, 350 customers had not paid. Between 61 and 180 days, 280 customers had not paid. Between 180 and 360 days, 170 customers had not paid. And in excess of 360, 100 customers had not paid. In total, you have 1,700 customers that have not paid at the end of your financial year. So in the books of accounts, when you look at your receivables, you find you have 1,700 that has not been paid. You are preparing your books for audit, or alternatively, you're preparing your management accounts to be discussed by the management. The question becomes, how therefore do you make a provision for bad debts for this aging analysis? Now, we have all agreed, but that because there is no significant financing component, we will use the simplified approach. So when we use the simplified approach, and we are now having our aging analysis as it is here, friends, then for us to know how they are going to default, they must have a relationship with how the same customers, this is as of 31st of December 2023, they will have a relationship with how the same customers defaulted in the year 2022. So that tells me, let me first leave my 2023 pending, and then I move back to 2022 first. I sort out to get the pattern on how my 2022 customers behaved. Then now I can come and deal with them in 2023. So that means I leave this alone. I move back to 2020 to 2022. So when I move back to 2022, what do I need to have a look at? I need to have a look at how these guys have performed. So as a good accountant, I now move back to 2022. But as I move back to 2022, before I look at how they have defaulted, I must first classify them together. But in this case, friends, allow me take an assumption that my customers in 2023 and my customers in 2022 are similar in terms of classification. Either they are customers who only bought vehicles, or they are customers who only bought motorbikes, or they are customers that only bought bicycles, or that they are customers that only bought sugar. So I cannot differentiate my customers. That is the assumption I'm taking in this case. Now that I have classified them, that they are behaving the same, then let me look at how my customers have defaulted. So therefore, I can go back to my 2022 year end, 31st of December 2022, and I ask myself, how much sales did I make in 2022? I can, for example, find that my total sales for the year were equal to 20,000. So from January to December, I sold 20,000. So if I sold 20,000, how did my customers pay me? Listen to how I'm approaching this. How did my customers pay me? Because how my customers paid me will dictate how they never paid. And that means how they defaulted. So I can come and I say, for the year end, 31st of December 2022, I sold 20,000. My sales were equal to 20,000, what happened? I need to know how I was paid. So I can say from 0 to 30 days, how much was I paid? From 31 to 60 days, how much was I paid? From 61 to 180 days, how much was I paid? From 180 to 360 days, how much was I paid? And in excess of 360, what happened? Remember, friends, this is not a body mass. My system might as well have 0 to 30, 30 to 60, 61 to 8, 90, 90 to 120, like that. The classification depends on how my system is. My responsibility is to use the system the way it is, to be able to compute the default of my receivables. So I can come, these are the age, then I can say the amount paid. So if, for example, I find within 0 to 30, I was paid 7,500. Good. I find 31 to 60, I was paid 6,800. That is fine. Then maybe the following one, I was paid 3,000. Okay. Then eventually, I was paid 2,200. That means if I have an amount that has not been paid, this amount that has not been paid, when I add together, it should give me my total sales, which is 20,000. Because had my customers paid everything, then it means it would have added up to 20,000. So if I received this, I received this, I received this, I received this, in excess of this, that means outside that 1 year, I have not received anything. So as a good accountant, I should then come down and ask myself, cumulatively, how was I being paid? So if I'm to get my cumulative payment, then this is 7,500. Then it means the total that I've received in the second period after this amount, I add the two, I get 14,300. If I add the third one, cumulatively, I've gotten 17,300. Then I add on, cumulatively as I move, I get 19,500. Meaning, what I never recovered absolutely, I never recovered 500 shillings. So the unpaid amount is, if I was paid 7,500, it means out of the 20,000, I was not paid 12,500. If cumulatively I have 14,300, then it tells me that they have not paid me 5,700. If they have not paid, if they have paid me 17, then it means I have 2,700 that was not paid. And then if they have paid me 90,500, it means there is 500 that I was not paid. That 500 that I was not paid, it is the write-off here. So first step, I am understanding the way my customers were able to pay me. I'm understanding the way my customers were able to pay me. This looks theoretical, but practically, how then do you analyze? Where will you get what you have been paid as 7,800? Where will you get what you are paid within 31 to 60 days of 6,800? My good friends, as an accountant, the process of the transaction as sales and receivables are concerned is if it is on 2nd of January 2023, you raise an invoice of 300,000. This 300,000 will automatically go to the debit of the receivable and will automatically go to the credit in the income statement. At the end of the month, you as an accountant, you must take your bank statement and do what is called a bank reconciliation. Let me tell you, I have said at the end of the month, but that is an ineffective way of doing bank reconciliation. You need to post your transactions evenly, be it daily or weekly, so that you minimize the risks of not remembering where this money came from at the end of the month, and you can have your good end month close process. I had diverted a little bit for me to be able to explain this. So as an accountant, when you want to know between 0 and 30 days, then you take your bank statement. You take your bank statement. If it is 0 to 30 days, then it means that lies in the month of January. How much did you receive? Two options. Either take the bank statement and total them together, or alternatively, go to your ledger of bank, highlight the period of 1st of January to 31st of January. On the debit side, see the money that came into your bank. And that you will use your ledger on one condition, that your reconciliation is up to date. If you know that your bank reconciliation is not up to date, don't dare. You would rather use the bank statement, because the ledger will be misleading. But if you have done your bank reconciliations very well, then to save on time, go direct to the accounting system and run 1st of January to 31st of January, put this figure there. Remember, at this time, where are you? You are on 31st of December. (31 to 60), come and run 2 months. 61 to 180, come and run. How many months they are? Put these figures here. The challenge we have with accountants is knowing where to get these figures from. But I've explained where these figures are coming from. Once you are done, you will realize that the amount that you are not paid, is how much? 500 shillings. You are never paid 500 shillings. These 500 shillings, when you compare with the total sales that you have cumulatively, what was the default? So once you have been able to get how much was not paid, then you move to step number 2 to compute the loss or the default rate of this amount on who? On all the stages that were set as a policy in your company. But there's something here. I'm going to write because I'm going to write something. But I want you guys to look at something. I have said that between the 0 day and the 30 days, I was paid 7,500. Now, when it comes to default, when it comes to the definition of the default rate, how much was not paid at this point? Some will tell me 7,500. Now, let me clarify something because I will wrap. When I am computing how much I have not been paid for, at the end of the month, at the end of the period, this becomes true. But when I'm looking at my historical rate of default, then I look at the beginning of the month, how much I had been paid and how much I had not been paid. At the beginning, I had not been paid full amount. They only paid 7,500 within the month. So at the end of the month, what was pending was 12,500. But at the beginning of the month, how much had I not been paid? I had not been paid my full amount of 20,000. So how do you calculate the historical default? We have gotten how much have not been paid. Then you come and you say, between and 30 days, between 31 and 60 days, between 61 and 180 days, between 180 and 360 days, and in excess of 360 days, at the beginning of the month, I had not been paid anything, so my 20,000 was still pending. But within the month, they paid me 7,500, so it remained 12,500. So when I started the second period, at the beginning, the balance that was remaining was 12,500. They paid further in that period of time. So when I started the next period again, whatever had remained was 5,700. Then like that, I remain with my 2,700. And then eventually, my 500 that was not paid. Now, this is what I have. What is my default rate? What is my default rate? This is the unpaid amount. Then I realized I had my 500 somewhere that had not been paid. Eventually, the total amount that I was paid the whole year is 19,500. So how much was not paid was 500. And how much were my sales? Were 20,000. So meaning, if I take my 500 shillings, divide by 20,000, I will get 2.5% default. I'll get 2.5% default. So the 2.5% default is what I come here and I say my loss here is 500, 500, 500, 500, 500. So my 2.5, which I had gotten, will be the first one here of 2.5%. When I come to my credit policy of the next stage, will not now be 2.5. What will it be? It will be 4, which is 500 of this. Then the next one, I will get, for example, 8.8%. And the third one, I will get 18%. And the last one is 100%. When I get the pattern of my behavior in 2022, this is the pattern of behavior now I am carrying to 2023 to say my customers will behave the same way. Nevertheless, how my customers have behaved is the same way they will behave in 2023, unless I have some macroeconomic activities that might take place in my business environment that might make my customer to behave differently. What are these macroeconomic activities that might come into play? The rate of unemployment. We are all aware that if the rate of unemployment goes high, it will have a ripple effect on my recoverability from my customers. So that tells me I need now to go back to 2022 and ask myself, do I understand what macroeconomic activities are? That's number one. So that I can be able to come up with them. Number one, do I know inflation? Yes. Do I know unemployment rate? Yes. Do I know interest rate? Yes. I can list all the macroeconomic elements and ask myself, now that I'm in this economic environment, do we have any of the macroeconomic activities that I've listed that I feel have a significant impact in the previous year? So I will do research. I will go to the central bank data and ask myself, what was the rate of inflation? If the rate of inflation was 2%, then I ask myself, if the rate of inflation is 2%, what was the impact on the receivables? If the rate of employment in 2022 was, for example, 7%, that was the rate of inflation, and then I ask myself, what was the impact in 2022? And I find that the default was this. So I'll ask myself a question. If, therefore, the rate of inflation in this year that I'm dealing with is 11%, then it will have a significant change. That 3% change might also shift this. So I shift my default with 3%. If the level of unemployment last year was, for example, 20%, and as a result of the rate of unemployment to be 20%, I realized this was the behavior. So I ask myself a question. Now that I'm in 2023, in this year, where the rate of unemployment now is not now 20%, it has shifted to 30%. then it means it's going to affect my recoverability. So I adjust my default rate with macroeconomic elements. But the issue is, I should not just adjust them mathematically or mechanically. I first ask myself a question: if the rate of macroeconomic element in the previous year I'm using as a benchmark to compute my default rate was this, and it gave me these results, what will be the impact this year? So if you can come to a conclusion, for example, if the political class have adjusted, maybe the leadership of the political class is okay, and the rate of inflation is going down, the rate of unemployment is going down, then you will realize that even your default rate will also come down. But when they have gone up, you should not just adjust automatically. Ask yourself a question: does that going up has an effect? Is the effect material? Because it is not just the effect, but the materiality aspect of the effect must also put into consideration. So the aspect of factoring macroeconomic elements is what we normally call factoring in the forward-looking information. Factoring in the forward-looking information. Now, if you find that the forward-looking information, which, for example, I've talked of the macroeconomic element, affects your default rate, adjust your default rate to mitigate the impact. Once you have adjusted the default rate to mitigate the impact, now you can carry this adjusted default rate to 2022, which is your current year now. So now you come and you say, okay, I'm done. What are my current figures now? The ones that I started with? I started with 700. I started with 800 for this year. And then I had my 350. And then I had my 280. And then I had my 170. And I had my 100. That gave me 1,700. Now you can be able to compute this multiplied by this to get the current provision for bad debts. So this figure you get by multiplying here, this figure you put here, this you multiply by this figure you put here, this you multiply by this, you put here, this you multiply by this, you put here, this figure you multiply by this, you put here. The total of these figures, if you get, for example, it's 400, this is what you make as a provision for bad and doubtful debts. All right? So what do? You can now bring this by debiting your P&L as impairment for bad and doubtful debts, and then you credit in your balance sheet, you credit receivables. There are two alternatives. You can credit receivables automatically, or alternatively, you can also create a liability called provision for impairment in the balance sheet, because some people never want to remove the receivables or reduce them physically. No, they want to leave them as block figure and then remove the impairment to get the net figure that goes into the balance sheet, but still retain the receivables as they are in full so that they can track them next year when they are recovering. I hope we are together, friends. I hope we are together. I hope we are together. I hope we are together. All right. All right. All right. All right. All right. All right. I have a question that I would want us to attempt, which I want to leave as an assignment that we try. I'm saying Bits Limited year end was 31st of December 2023. It had the following. This was the aging analysis as at the end of 31st of December 2023. So as at 31st of December 2023. However, as 31st of December 2022, the aging analysis was here 15,000, here was 60,000, here was 35,000, here was 10,000, and here was 4,000. I hope you get what I have done. And you are told that in the year 2022, in the year 2022, in the year 2022, the total sales that were made, total sales were equals to 140,000. That is the information you have been given as an accountant. Number two, you are being told that the rate of inflation 2022 and 2023, we have inflation and we have rate of unemployment. Rate of unemployment. So inflation in 2022 was 4%. In 2023 was 9%. And according to your judgment, this rate is material. But the level of unemployment, you found here it was 25%, but here was 26%, and this was immaterial. And you are being told that this customer has a credit policy, this company has a credit policy of 30 days. The question you are being asked, friends, The question you are being asked is kindly, can you give us the provision for bad debts according to IFRS 9 expected credit loss of 2023? Remember, the expected credit loss we want to compute in 2023 must have a basis. And we said the basis has to be 2022. And for you to have a basis of 2022, you must have the total sales. So that out of the recoverability that was done in 2022, you can know how much defaulted. And whatever never paid must be the basis of computing the default rate. And this default rate is what needs to be assigned here. But remember this default rate, I redistributed them on the classes of the credit policy that I was received. And then once I was done, I also looked at the forward-looking information, which I said macroeconomic activities or elements. And I brought in the aspect of inflation, and I've also brought in the aspect of unemployment. But I've told us as accountants, we must be able to evaluate the materiality of this shift. That's why I've also given my own judgment and said that for inflation, it is material, but for unemployment, it's immaterial. Can we try? Can we try, friends? So let's try. And if we get challenges, you can let me know. We can work out together. We try. If we find challenges, we can work together on this assignment. We can work together on this assignment to get the answer. We can work out on this assignment to get the answer. So I've given us the hint that for us to be able to come up with the impairment ECL in 2023, we must go back to 2022. The sales is very important to get the default rate that we are going to redistribute. And after redistributing the default, then we move on to incorporate in the macroeconomic elements to get the new default rate that we are going to use now to assign to our 2022 and be able to get our provisions for bad debts. All right, friends. So once we finish that, then we can move forward. We shall have finished one part of provision for bad debts, and that is by using the simplified model. So we can now move in and start using what is called the generalized model, where there is significant financing component. So there we shall adopt the 3 steps approach, classifying them together, using the 3 steps approach, and obtaining our expected credit loss. Where is it applied? The generalized model. Mostly it is applied when we are dealing with receivables or contracts that have a financing component. So that means we must discount our cash flows. So that's what we'll deal with next time. We had to exhaust this in full. Why? Because most of us, this is where we are. But for those who work with banks, microfinance institutions, those who have been employed by Shylocks, where interests are charged, then remember in our next discussion, that's what we'll be dealing with and using the generalized model. Otherwise, thank you so much, friends. I have left this assignment that we all have a look at, work on it, and then if need be, that members will feel we can discuss it together, then when we meet in our next lesson, we can be able to see how we can discuss it together. If there's no need, that all of us have gotten it well, then well and good, we can move to the generalized model and see what we can be able to do. Otherwise, thank you so much. We've been moving on for the last 2 hours. We started at 1. Now we are headed towards 9 minutes to 2 without a break. It's important that we can have a break for these 9 minutes, and then we can close it at that. Otherwise, thank you so much, friends. God bless you. I hope this one is of value. It makes us competent accountants, makes us effective at our workplace, and it makes us deliver results as expected from our employers. So see you again next meeting. That is on Saturday at